Today, we're doing a complete breakdown of ASC 270. We'll cover the scope, core principles, measurement, journal entries, and real interview questions. Whether you're studying ASC, prepping for a Big Four interview, or working in finance, this is everything you need to know. Before ASC 270, companies often had inconsistent interim reports, leading to confusion among investors. Imagine a mid-year report that diverged significantly from annual figures, creating chaos. ASC 270 standardized this, ensuring financial clarity every quarter. By the end of this section, you'll grasp how ASC 270 brought uniformity and transparency to interim financial reporting. ASC 270 emerged to tackle the inconsistencies in interim reporting that bewildered investors and stakeholders. Businesses once published quarterly figures that didn't sync with annual reports. This standard mandates that interim financial statements align methodologically with annual disclosures, promoting comparability and consistency. By ensuring this alignment, ASC 270 enhances investor confidence and decision-making through transparent and reliable quarterly data. ASC 270 is crucial for publicly traded companies in the U.S., standardizing interim reporting since 1973. Before this, interim figures were disparate, causing confusion. The key mandate? Consistency in methodology between quarterly and annual reports. This ensures financial figures reflect an accurate, ongoing picture. Failure to comply risks not only investor confidence, but also attracts regulatory attention, making adherence essential for credibility. The interim financial reporting model under ASC 270 is pivotal for aligning quarterly data with annual reports. It treats each interim period as an integral part of the fiscal year, smoothing out financial surprises at year-end. Mastery of this model, especially during interviews, highlights your understanding of financial continuity and its impact on investor relations, reflecting an adeptness at navigating the complexities of financial reporting. Scope matters because it defines who needs to comply. A common mistake is assuming annual financial statements are covered by ASC 270. They're not. This is a classic interview trap. Exclusions like non-public entities often trip candidates up, but understanding these distinctions can set you apart. ASC 2070 applies to publicly traded companies, requiring them to produce quarterly interim financial statements. Investors depend on these interim reports to make informed decisions. These statements offer a timely look at financial health, ensuring transparency and market efficiency. Missing this requirement could lead to significant compliance issues. ASC 270 explicitly excludes annual financial statements and non-public entities not obligated to report interim results. Many candidates mistakenly think annual reports fall under this standard. Understanding these exclusions is crucial, since private companies aren't required to comply. These distinctions are common interview pitfalls. Be clear on where the standard doesn't apply. Interim financial reporting involves financial statements that cover periods shorter than a full fiscal year, such as quarterly reports. For example, a company reporting on its first 3 months of the year provides insights that aid in decision-making. Interim reports help investors assess ongoing performance, offering a glimpse into profitability, liquidity, and financial position. An interim period is any reporting period less than 1 year, typically a quarter. For example, a company might release financials for January to March. These reports help stakeholders gauge a company's performance between annual reviews, offering essential updates that guide investment decisions and regulatory compliance. Understanding scope edge cases can be challenging. For instance, ASC 270 doesn't apply if a private company voluntarily prepares quarterly reports. If a public company skips a required interim report, it's non-compliant. The standard also doesn't dictate monthly financials even for public entities. These nuances can often trip candidates up in interviews. Clarity is key. Imagine a company needing to pivot its strategy halfway through the fiscal year. Interim financial reports provide the agility to make informed decisions quickly. This model ensures consistent and meaningful financial data across periods, vital for stakeholders. Dive in to see how companies like Meridian Corporation handle complex contracts smoothly under such guidelines. Interim financial reporting ensures businesses maintain transparency and accountability throughout the year. We'll track Meridian Corporation's $10 million SaaS contract with Acme Incorporated to illustrate this model. By applying the structured steps, companies can provide reliable interim financial statements that align with annual reports. This process balances the need for detailed reporting with the constraints of shorter periods. Start by establishing the interim period, often quarterly, to maintain consistency with annual financial statements. For Meridian Corporation's $10 million SaaS contract with Acme Incorporated, we fixed the first quarter as the initial reporting period. This foundational step ensures we track performance accurately through each segment. Misalignments here can lead to skewed financial insights, impacting decision-making. Establishing this timeline is crucial for accurate interim financial insights. Recognizing revenues and expenses as they occur during the interim period is crucial. For Meridian Corporation, this means recognizing $2.5 million of the $10 million SaaS contract revenue per quarter, aligning with service delivery schedules. This precise alignment prevents discrepancies and ensures the interim reports reflect true financial health. Missing this step can skew financial interpretation, making accurate recognition and measurement essential for credible financial insights. Disclosing significant post-period events is vital for transparency. For Meridian Corporation, this means reporting client acquisitions or terminations that impact the $10 million SaaS contract's financial projections. These disclosures ensure stakeholders have a complete view of potential impacts on financial outcomes. Omitting such events can lead to misleading financial interpretations, stressing the importance of thorough and timely disclosures in the interim reporting process. Consistent accounting policies between interim and annual reports ensure coherence and reliability. Meridian Corporation must align its policies for the $10 million SaaS contract across all reporting periods. This consistency prevents discrepancies that can confuse stakeholders and distort financial analysis. Deviating policies undermine credibility, emphasizing the need for steadfastness in applying accounting principles throughout the fiscal year for accurate and credible reporting. The measurement method you choose directly impacts your balance sheet. A wrong choice can overstate assets by millions. ASC 270 guides you on what must be recognized and disclosed, ensuring accuracy and transparency. This standard helps avoid costly errors and keeps financial statements reliable, giving stakeholders a true picture of financial health. Recognizing assets or liabilities under ASC 270 requires meeting specific criteria by the end of the interim period. Assets should be measured at cost, including directly attributable expenses. For example, if an asset costs $100,000, that amount plus any installation costs should be reflected. Recognition occurs on the balance sheet date specified, ensuring consistent reporting. The materiality threshold helps determine whether items should be capitalized or expensed immediately. ASC 270 emphasizes the need for periodic reassessment of recognized amounts. For example, if an asset's fair value changes due to market conditions, companies must adjust its carrying amount. Depreciation or amortization systematically allocates costs over time. Trigger events like impairment indicators lead to reevaluating carrying amounts, ensuring reported values remain accurate. This approach reflects the asset's real economic condition, avoiding overvaluation on financial statements. Under ASC 270, assets and liabilities appear on the balance sheet, impacting how stakeholders view financial position. Classification into current or non-current categories affects liquidity analysis. For example, short-term assets like inventory are current, influencing quick ratio calculations. Notes provide clarity, detailing recognized items and measurement basis changes. Such transparency aids stakeholders in understanding adjustments, like fair value updates, ensuring informed decision-making. ASC 270 mandates key disclosures like measurement basis, impacting how users perceive valuation accuracy. For instance, if a company changes its depreciation method, this must be disclosed to explain variances. Significant estimates such as asset life need disclosure, highlighting management's role. Remeasurement adjustments offer insights into financial impacts. These disclosures provide transparency, helping analysts understand the company's valuation approach and financial health accurately. Imagine a CFO facing a market downturn, realizing an asset's fair value might have dropped. the CFO reevaluates it, reducing its carrying value from $200,000 to $180,000. This change impacts financial statements, adjusting the balance sheet and income statement. Disclosing this remeasurement ensures stakeholders understand why it occurred. This practical approach illustrates ASC 270's role in maintaining transparent and accurate financial reporting, aligning reported figures with real-world values. Meridian Corporation, a global manufacturing company, signs a 5-year operating lease for its Singapore warehouse. Watch how every accounting event plays out, from initial recognition to ongoing adjustments. See the complete impact on Meridian's financial statements as they apply ASC 270. At lease commencement, ASC 270 requires Meridian to recognize both a right-of-use asset and a lease liability. This aligns with the principle of recognizing an obligation to make lease payments and a corresponding asset representing the right to use the warehouse. The balance sheet now reflects a $1 million asset and liability, showing financial commitment and control. Every month, Meridian reduces its lease liability by the cash paid, here $16,667. ASC 270 mandates this, ensuring financial statements reflect both the payment outflow and reduced obligation. This entry decreases cash and lease liability, indicating progress in fulfilling lease commitments without affecting profit, since it's a balance sheet activity. Under ASC 270, part of the lease payment is interest expense. Here, $5,000 reflects cost of borrowing implicit in the lease. This expense impacts the income statement, reducing net income, while the lease liability increases by the same amount, capturing the true cost of using the warehouse over time. Amortizing the right-of-use asset ensures Meridian Corporation reflects asset consumption over time, in line with ASC 270. This $16,667 monthly charge reduces the asset's book value and impacts the income statement as an expense, aligning financial reporting with asset usage and enhancing transparency for stakeholders. Exchange rate fluctuations can alter the lease liability for Meridian Corporation. ASC 270 requires recognizing this $2,000 foreign exchange loss, reflecting economic realities on the financial statements. This non-cash adjustment impacts the income statement, aligning reported figures with real-world conditions, crucial for accurate financial reporting. ASC 270 allows for lease term reassessment when circumstances change. Meridian extends its lease, increasing both lease liability and right-of-use asset by $10,000. This reassessment reflects a longer economic benefit period, updating the balance sheet to mirror revised business plans, crucial for maintaining financial statement accuracy. As Meridian Corporation fulfills its lease obligation, ASC 270 mandates derecognition of both the lease liability and the right-of-use asset. This $1 million entry clears the balance sheet, reflecting completed obligations and asset usage. This step closes the lease chapter, marking the successful capitalization and management of the warehouse lease. Every Big Four and investment bank interview on ASC 270 follows a pattern. Here are the 10 questions that come up again and again, with answers that will make your interviewer nod. ASC 270 covers interim financial reporting, providing guidance on how to prepare financial statements for periods shorter than a full fiscal year. It ensures consistency and relevance in financial data between annual and interim reports. Understanding ASC 270 helps avoid confusing interim with annual reporting requirements, a common trap. Remember, interim reports are crucial for transparency and timely information. ASC 270 requires interim financial statements to provide timely and relevant information to investors and stakeholders. These reports offer insight into a company's performance between annual reports. The goal is to enhance decision-making with more current data. A common mistake is assuming interim reports are less critical. They actually reveal trends and adjustments earlier. Companies should apply the same revenue recognition criteria for interim periods as in annual reports. Recognizing revenue when earned and realizable avoids misstatements. ASC 270 emphasizes consistency in accounting methods, aligning with ASC 606. Avoid misapplying criteria by ensuring revenue recognition reflects actual performance obligations. consistent application ensures accurate interim comparisons. Expenses in interim periods should be recognized using the same principles as annual periods, matching costs with revenues. ASC 270 requires that all known adjustments be accounted for in the interim period. Avoid the trap of overlooking these disclosures, ensuring that all relevant information is included for accurate interim reporting. Under ASC 270, interim reports focus on discrete periods, while International Financial Reporting Standards treats them as integral parts of the yearly report. This difference impacts how adjustments are treated. A common mistake is not recognizing these nuances, which can lead to incorrect consolidation or disclosure. Always check the specific framework requirements. Interim reports under ASC 270 require adjustments for items that affect the entire fiscal year. Adjustments should reflect any changes in estimates or corrections. Avoid the trap of deferring these to annual reports, as interim adjustments ensure more accurate period-end reporting. This approach improves fiscal year comparisons. For a subscription starting in February, recognize revenue evenly across periods. If annual subscription is $1,200, allocate $100 per month. Ensure adjustments for partial months are included. This prevents recognizing revenue prematurely. A common pitfall is failing to account for service delivery timing, leading to inaccurate interim statements. ASC 270 excludes comprehensive income items from interim reporting requirements. This is a common mistake, as not all items require interim disclosure. The rationale is that certain items do not significantly impact decision-making within interim periods. Recognize this exclusion to prevent unnecessary disclosures that could confuse stakeholders. CFOs must disclose material changes in financial condition and results of operations for interim periods. This includes any significant changes in accounting principles or estimates. ASC 270 requires transparency to inform stakeholders of potential impacts. Misunderstanding these requirements can lead to inadequate disclosures, affecting investor trust and compliance. ASC 270 is all about ensuring timely interim financials, vital for stakeholders' decision-making. Covering periods shorter than a fiscal year, it demands consistency with annual reports, segment data inclusion, and comparative statements. Materiality focuses on interim-specific items, ensuring stakeholders get a realistic view at each stage. The interim financial reporting model views each period as part of the annual total. Revenue recognition mirrors annual methods, while costs are allocated across applicable periods. Inventory and unusual items are adjusted and disclosed as needed. Income tax estimates apply an annual effective rate, aligning interim and annual results. Key interview points: maintain consistent accounting principles between interim and annual periods. Disclose significant changes in estimates, and understand ASC 270's distinctions from IAS 34. Segment and EPS presentations must be accurate, reflecting interim performance. Immediate disclosure of material events is crucial, as is pro forma information for transparency on key changes. That's your complete guide to this accounting standard. If this video helped you, please like and share. It genuinely helps us keep creating content like this. Drop your standard requests in the comments. Subscribe to Candy Mentor for more accounting and finance videos.